And let's talk about sit tight, right? Because that's where the problem comes, isn't it? I think psychologically, that's where we go wrong as investors because we're just not willing to be patient. Suddenly, the tide turns and we think, oh, everything is wrong with equities. So, I want to talk a little on the psychological point of sit tight.
Yeah.
Once you've bought a good company or a good fund through which you bought a company, how psychologically do you need to attune yourself to sit tight? Because you panic, you start selling, and that's what Indian investors most often do, isn't it?
So I think, it needs a lot of perspective and needs a lot of maturity. I myself have witnessed that, when, for example, when the performances are great, then the trust is also high and the willingness to believe and the willingness to hold on is also high. But, the best of managers and the best of investing philosophies will always go through a particular patch, right? Because if you run a portfolio which works in every market scenario, then basically you got to be Nostradamus. It's not possible. So the best of investment managers with steadfast practice of the most soundest of investing philosophies, they will also go through a patch. So I think from investors' perspective, having a good perspective of the markets, of who are you entrusting money to, I think that is very important. And having these wild swings, that if the performance is great, then the trust is there and everything is fine. And if a performance goes through a patch, then I think everything has just got undone. So I think seeing things in a more reasonable manner, keeping the perspective at all points in time, not having unrealistic expectations, I think a lot of things go towards being able to actually sit tight.
Do you believe somewhere that expectations are a bit unrealistic at this point of time?
See, I think the disappointment is because of unrealistic expectations, and I can't say, and a lot of it is also got to do with my industry and how we communicate and the kind of products we offer or the way we conduct ourselves. So obviously the industry also has a role to play, but talking about meeting expectations, you look at it this way that, when you opened, you clearly mentioned a fact that in the last few months, mid-cap stocks have fallen, the indices have fallen 15-20%, and there are many stocks which have fallen a lot more. But what we must not forget that 2017 as a calendar year, the mid-cap index went up by 48% and the small-cap index went up by 57%. Now, something which goes up 40 to 60% in a period of 12 months, in the subsequent few months, if it falls by 15-20%, on its own, the 15-20% is bad. But keeping the whole perspective in mind, I mean, it's kind of a reasonable thing to really happen. Where realistic expectations are needed is that if you are managing money yourself or you entrust it to a mutual fund, clearly equity is not the kind of asset class where you assess performance in 3 months or 1 year, or sometimes even 18 months is not enough, 2 years is also not enough. You look at it this way, I run a business. Let us say you give me a target, then I need to increase the margins on my business by 5%. I will take a couple of years to change those margins, right? So there are live businesses run by real people who are executing certain things. It takes them months and quarters and years to be able to deliver on a certain strategy. And we as shareholders are owners of those businesses. How can we expect that every 6 months, every 9 months, they will consistently produce those kind of stock price movements? I mean, it's the earnings which matter. Stock prices can keep yo-yoing. So it's a lot to do with having realistic expectations and the gumption to hold on for 3, 4, 5 years.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.